Thank you very much for tuning into this video. I'm Sean Mercer, along with my partner Patrick Jolliffe, President and CEO of Jolliffe Capital, Inc., a registered investment advisory firm here in the Denver metro area. And today, Patrick is going to provide some education and information, the two most valuable things a person can get in life, on mutual funds and exchange-traded funds. As we know, there is a lot that has been in the media today about mutual funds and exchange-traded funds, and he's going to discuss in depth today what the difference is between the two and how you may want to position your portfolio moving forward to have a better retirement. Patrick?
Thanks, Sean. I appreciate that, and thanks again to all of you for taking the time to watch this video. The intent today is to try and help you understand the difference between mutual funds and exchange-traded funds. And when you look at them on the surface, they look very much the same. We'll start at the beginning. We're speaking to a large audience, and so we don't want to assume too much. Basically, what you're looking at in a mutual fund and an exchange-traded fund is a basket of investments. It might be a basket of stocks, for example. It could be a basket of bonds, for example, or it could be a basket of both. Mutual funds, those baskets of investments are managed by a manager. Okay? An exchange-traded fund doesn't have anyone managing the basket. We'll talk about that a little bit more here in the future. Back to the mutual fund. Since there's a manager that's managing the stocks and bond sales within that mutual fund, they obviously are going to get paid for that, and they charge a fee. Well, according to the averages within our industry, the average annual fee of a mutual fund is about 1.5% per year. And then also, in addition to that, there are fees that are referred to as undisclosed fees. That's not because a mutual fund's not wanting to tell you about it. Undisclosed fees are based upon the activity that goes on within the mutual fund throughout the year. So as you have that manager buying and selling stocks within the fund itself, that's going to incur some trading costs. And those are the undisclosed fees that we never know in a mutual fund until the end of the year what they are. Now, according to the Fiduciary Institute, undisclosed fees, in addition to the expense ratio that's being charged by the manager, the undisclosed fees add another average 90 basis points. So 100 basis points is equal to 1%. 50 basis points is equal to 0.5%. There's an average 90 basis points additional cost per year in mutual funds about which we're not aware, and they've actually been reported as high as 600 basis points, so that's another 6%. But if we just took the averages, if we said the average annual expense of a mutual fund is 1.5%, and then we add on another 90 basis points, we're averaging an expense of about 2.4%.
So Patrick, if somebody was at home taking notes right now, could you just put that up on the board for them so they would know what to write down and sort of what to look for?
So a mutual fund.
And this is industry average, correct? Some could be less, some could be more.
Absolutely.
But, okay.
Average expense. Okay, and in case you haven't heard the term, it's in the industry, this is referred to as an expense ratio. The average annual expense, okay, so that's annual now, is 1.5%, okay? And that's what we find as an average expense per year. Then we have undisclosed fees that are added, undisclosed, or expenses, okay, and they average 90 basis points, which is almost another 1%. So if we add the two together, what is that, 2.4, right, per year, okay? So that's what you're charged. So, you know, you just take it right off the top. If you have a fund that gross returned 10% for that year, your net return is going to be the 10% minus the 2.4. Now, here's what's interesting. Okay, this is where we start seeing the rubber meet the road a little bit. What are we paying for when we buy a mutual fund? We're paying for active professional management, right? So if we're doing that, I guess it would be an expectation of most clients that they would like to outperform the market in general. And yet here's what the statistics tell us. The S&P Composite 1500 in 2012, you know, the Standard & Poor's index, beat 89.84% of all actively managed domestic stock funds in 2012, according to U.S. News. 89%. In other words, 90%, almost 90% of the mutual fund managers in that environment failed to beat their own benchmark. And yet, that's typically what we're paying them to do, all right? Difficult. Over the past 3 and 5 years, those numbers were 73.24% and 67.72% respectively.
So Patrick, basically what we're talking about here is over an extended period of time, most mutual fund managers, 70% of the time, underperform.
That's correct.
And then here's the other kicker, is that if this is somewhat sort of the average, if a person is out there tuning into this video today, what other fee could be added on top of that from, say, maybe their advisor who is putting those portfolios of mutual funds together?
Okay, it's a great point. We have a lot of that going on in the industry. And so it's quite common that if you're working with an advisor today, that they might be using mutual funds as the investment vehicles for your money, but they also need to get paid. And they might even say, you know, we're a fee-only firm, and so we charge a fee to manage your money. We do the same thing, only we don't use mutual funds. We'll get into that in a minute. But let's say that your advisor, just to keep the math easy, charges 1% per year. So we'd have to add that on to the average expenses of the mutual fund portfolio. And to Sean's point, wow, now we're paying 3.4% per year. Okay? Just deduct that directly from the gross return of the fund, and that's what your earnings are. And keep in mind, too, that the philosophy of the mutual fund is to do exactly what the prospectus says, and that is to return as much as it possibly can to the shareholders. I wonder how many of you out there have ever actually met one of your mutual fund managers. That's not the way it works, right? They don't know you and you don't know them. Their job is to get the maximum amount of return that they can for all their shareholders, and that's okay. On the positive side, I think mutual funds are good for diversification, and I think they're good for people that are getting started in investing, okay? Because you can get started with $25 a month, you're diversified and so forth. It's difficult to go out and diversify a stock portfolio with $25 a month. But there's a lot of folks out there, I'm sure, that are listening that are well above even the $100,000 mark, and yet you're still in vehicles, mutual funds like this, spending this kind of a fee and getting exactly the same service that the new person starting out giving $25 a month is getting. So let's talk about you folks that are out there that have actually accumulated some investment assets. What's one of the most important things that we can do as a fiduciary and a money manager, okay, as a registered investment advisor, to help you get the most out of your investments? Well, we certainly want to try and help control what your fee structure is, okay?
You know, Patrick, not to interrupt, but I have one particular scenario that I want to bring up with this, and it very well might be you, the viewer today. How many times have we had people come into our firm and they state to us, oh, my financial advisor's great. He's only charging me 1% a year to manage my money. And we hear that a lot. And it's very tough at times to be able to lay it out for people that it's, no, you're not only being charged 1% because your advisor is utilizing mutual funds with those expense ratios. Anytime that is there, it's a direct subtraction from your portfolio. And folks, if you don't hear anything that we say today, the most important thing is to mitigate your annual fees. The less fee, the more money you get to put in your pocket, the more money you get to spend on your grandkids, the more money you get to go on vacation with. It is very, very important. And what we want to stress is if you just want a very simple analysis to find out exactly what you're paying, we are more than happy to do that for you.
Thanks, Sean. That's a great point. And this is a wonderful service, and it's a very simple report that we'll provide for you. If you can fax to us, or you can email to us securely via our secure email portal your most recent statement from your investments. And what we do, I'm an accredited investment fiduciary, and so that gives me access to the fund analyzer at the Fiduciary Institute, and they use Morningstar data and a whole bunch of other market industry data. We plug in your investments, and then it spits out a report for us. It's completely objective, but what's nice about it is it's easy to understand because they use a scoring system. And believe it or not, it's like golf. A 0, the lower the score, the better. So if your fund has a 0, you can't get any better than that. But what's nice is we can turn these around pretty quickly, and we won't charge you for it. It'll start to give you a really good feel for the health of your portfolio and how, for example, some of the things that are looked at within the analyzer itself are obviously fund performance, expenses, manager tenure. By the way, I don't know if you know this or not, but you're a football fan, right? Mm-hmm. The average tenure of a mutual fund manager is equal to that of a professional football player. It's just under 3.5 years, okay? So what you have then also is you have inconsistency in management, all right? All right, enough about that. We're going to talk about briefly what do we do for our clients to help grow their money, hopefully, right, and manage their expenses. So in another video, we've also talked about personal benchmark rate of return calculation. We don't like to shoot without a target, and so we help you develop that target so that we're all comfortable in understanding what your money needs to do for you. And then we devise a plan for you, and we put you in one of our low-cost exchange-traded fund portfolios. And we have 6 of them, all the way from very conservative to more aggressive. And I'll just tell you flat out, we're not that aggressive anyway. We believe in broad diversification, predominant market efficiency, and so forth. And we can talk about that when you contact us. Obviously, it's an intimate relationship, and we tell you about how the watch works a little bit. But just to give you an idea, bear with me while I free up some space. Remember this number, this 3.4%. That's the average of what a lot of mutual funds are costing when you're working with an advisor, and that doesn't even take into account any commissions that might be paid as well to the advisor if in fact they're doing that too, okay? So an exchange traded fund in comparison to a mutual fund, remember I said they look the same? An exchange traded fund does not have a manager on the basket of stocks or bonds or the combination of both. So there's no one to pay for it. Interesting. But it does incur some transaction costs because every once in a while it sells out or buys in. Here's the difference. When you have a mutual fund, let's say it's a domestic stock portfolio fund, it's going to buy certain stocks of certain companies that do predominantly their business in the United States. In an exchange-traded fund, who gets to be in there, the stock that gets to be in there, or the bond is defined by the market capitalization, or how much the company is worth. So let's say we want to go out and buy a small company exchange-traded fund. We do that, we buy it, it's got a basket of stocks that are of small companies. So if the small company grows to, say, a mid-sized company, now it's going to be sold out of the small company exchange-traded fund, and it's going to be put into the mid-cap or mid-sized company exchange-traded fund. Okay, so it's an automatic type of thing. Our job is to set up a portfolio for our clients. Remember I said that we had 6 portfolios ranging from most conservative to most aggressive. And let's just say that for this example, that you happen to, we call it testing into, our moderate income model. Okay, you're in retirement, you're looking to get income for retirement and so forth. When we say test into something like this, we have a fairly robust questionnaire in addition to interviewing you to help us understand what your level of risk tolerance is and so forth. And then what we do on our end in putting this portfolio together for you is we use, like I mentioned, we use low-cost exchange-traded funds. When I say low cost, when we custody most of our money with Charles Schwab and Company. They have a number of exchange-traded funds that we use in our model portfolios, and the average annual cost of those is actually 7 basis points. Okay, so yes.
So now, Patrick, when you're talking 7.07007 basis points versus the average cost of a mutual fund, what is the difference then in average expense ratio?
Well, the average expense ratio of a mutual fund is 1.5%. Okay, so in this case, for doing the math, because these are percentages, it's a 1.43% cost savings just on the fund itself.
Savings. That could drastically, folks, increase the money you get to keep in your pocket when you start amortizing that out over, say, a 10-year time frame.
Correct. Now,
it is dramatic.
Interestingly as well, we talked about undisclosed mutual fund expenses before that averaged 90 basis points. Well,
and once again, correct me if I'm wrong, Patrick, that is just the trading inside of the mutual fund, what the mutual fund manager is buying and selling. And so it's not clearly spelled out in the prospectus because they don't really know what those fees are going to be.
They just know there's going to be some.
There's going to be some.
Well, we know that if you can think of us now as the manager of the moderate income model, okay, and we have, just so you know, it's not just Sean and myself, but we have a PhD in economics, Dr. Chowdhury. We have a certified investment management analyst in Barry Mendelson. We have 2 chartered financial analysts, Rick Wansky and Jolie Keller, that all of these folks are involved in doing the research with us consistently, day by day, on a global basis to help us determine what the best allocation is today for a person who wants to be invested in our moderate income model. Okay, well, what do we put in there? I'm going to show you baskets. I can't draw to save myself, but these are supposed to be baskets. And what they are is they're ETFs. Sorry. Okay, so we have a number of different ETFs in here. Okay, that's what all these are. Okay, and you know they'll have various different types of investments in them and so forth. We're going to sell them out and buy them in. When we do that, that's a transaction. What did we say about the undisclosed costs in a mutual fund? They average
0.90 basis points, just a little bit less than 1%.
Yeah, and what it costs us to trade Charles Schwab ETFs inside of this model is 0.
Nothing.
0. There's no transaction cost that our client has to incur. So let's get down to the nitty-gritty, because this will become a shocker, but we don't work for free, okay? What we do is we tell the truth, and by law we're held accountable to a fiduciary standard, which means we work for you and you only, and everything is fully disclosed, all right? So our average fee that we charge as a firm to pay all of our folks for doing this, what we publish is 1.45% per year, okay? And then we know that we've got an internal expense on average in these exchange traded funds of about 7 basis points, right? Excuse me. So where are we? 1.52%. Now, what did we say the average expense ratio of a mutual fund is?
1.50.
Right, exactly. So what's the difference? Well, the difference is you're working directly with us. You know everybody that is running your money, that's investing your money. It's based upon a plan specifically for you, and there's a whole bunch of other stuff that we get to do for our clients, like tax management and so forth, each and every year, so that we work to minimize your taxes, capital gains, short, long term, and so forth. when we're managing what we refer to as non-qualified accounts. So when we looked at the mutual fund example before and we added all of the fees together, we were looking at an average of about 3.4% per year. Okay, and that's in a publicly traded vehicle where you'll never meet anybody and you're getting the same service as the fella down the street that just got started getting out of college doing $25 a month, to a fully customized portfolio that's going to be managed specifically for you on your behalf as a fiduciary. Nobody else telling us what to do, only you. And this is your average expense right there. What it means is it's huge. If you're shooting at the moon and you're off just a little degree, by the time the bullet gets out to the moon, it's way, way off course. Well, that's exactly what this means. Anytime you can save expense, it can make a dramatic impact on your portfolio, how it grows and how long it lasts. And one thing that we need to be mindful of is, even though we're not necessarily curing our diseases, we've had all of these leaps and bounds forward in the medical field, it's keeping us alive longer. So I say that because it makes it more difficult for us, right? We need to sit down and plan because our lifespans are getting longer, right? And so that's everything that we can do to help grow the money and help manage the expense and do it according to your own risk tolerance is the most important thing. And if it's not with us, that's okay. We have a report that we'll send you that talks more about all of this, but we would stress, please work with a fiduciary. You have the opportunity to do that. We're held accountable by law. That's good protection for you. We only work for you, and we put your best interest first, period.
So once again, folks, if you're sitting out there and you would like to get this free report that Patrick's going to give me, we'll be able to get that into your hands. And here it is right here, into your hands. And if you have any further questions about mutual funds, about stocks, about bonds, about how ETFs might benefit you and your family in retirement, please contact our office at 303-469-6273, and we'll be able to get this report in the mail to you. And once again, on behalf of Patrick Jolliffe, this is Sean Mercer. We're very thankful, and we want you and your family to have a prosperous retirement.